All right, topic of discussion is regular schemes and direct schemes. What kind of investor should be actually opting for regular schemes under mutual funds? And if at all you are an investor who's been investing in regular schemes or investing through regular schemes, if in case you are well versed with the market and the way mutual funds work, do you want to shift towards a direct scheme format where you can get a slightly higher return? What is the reason behind the variation and difference in returns between a regular scheme and a direct scheme? Let's understand all of these things. Today I have with me Nirav Karkera, Head of Research, FISDom. Nirav, good evening and welcome to the show. So Nirav, before we suggest strategies to our investors, whether to go for a regular scheme or a direct scheme under a mutual fund, what exactly are regular and direct schemes? Let's start with a very basic set of understanding on this.
So, hi Kavita, always a pleasure to be speaking. Also, this is a very interesting topic. In fact, it has been catching a lot of attention of late, with investors growing more and more savvy and understanding the different plans available. It has become imperative to understand the difference between regular and direct plans. So, one step that we'll take behind and two is the expense ratio, right? We need to first understand what's an expense ratio. So, an expense ratio is basically a cost or a charge that is charged to a fund. Okay, this is a charge levied to a fund. This is levied by the fund house or the fund management team. Right now, this charge is levied on account of the expenses that a fund house needs to incur to run a particular fund. Now, this could include fund management fees. This could include administration charges. This could include a whole host of other expenses that the asset management company has to pay for. This would also be a primary source of revenue for asset management companies. So this is what an expense ratio is all about. So there is a marked difference between the expense ratio of a regular plan and a direct plan. And in fact, this difference in the expense ratio makes the whole world of difference to an investor. So what happens in a regular plan is that this expense ratio also includes a component of distributable commission. So let's say if the actual expenses that can be charged to a fund or that an AMC wishes to charge to a fund is X. The expense charged to a regular plan is, let's say, X plus a certain percentage. Now this certain percentage is the percentage that is generally reserved and set aside to be distributed to distributors in the form of commissions. Okay, so regular plans are basically plans with a higher expense ratio versus, as you would have fathomed by now, direct plans wherein there is no such element of distributable commission. The only charges that are charged are the charges that the AMC wishes to levy on its own behalf alone. So there is no provisioning for distributable commission here. Right. So direct plan expense ratios are slightly lower because of this differential. So direct plans are generally accessible also through direct AMC websites, etc. But for a to avail a regular plan, it is often offered by a distributor. It has to be a SEBI registered mutual fund distributor, and this is the commission that they will receive from the AMC just because they are filling the service layer, wherein an investor is assisted across various levels of operationalities.
I think that's a very important part about a regular plan. You know, if you are an investor or if a person who is not well versed with the equity markets and is unable to decide for themselves, having a regular plan is definitely good for you because you will be guided and you'll be helped at every step of your investment. At the same time, direct mutual funds work for those kind of investors or slightly experienced investors who know how to take a particular call on their own. But apart from that, let's also elaborate more on the kind of services you get if you are buying a regular plan. And also one more thing, Nirav, a common point of confusion among investors or viewers that we also come across is a lot of times they think that buying mutual funds from any fintech platform is also buying a regular scheme of a mutual fund. How different is it? Do we only get direct schemes on other fintech platforms or online platforms from where you buy funds?
Yeah, so I feel I'll take the second question first. It is a very important confusion that we must clear. So there are several fintech platforms that are available. However, each one of them has a very distinct and different proposition. Some of them offer regular plans and some of them offer direct plans. Now, there are very distinct business models that are approached, that these fintech players are approaching with. One very important thing that you must be on the lookout for is reading the scheme name in entirety, because all these fintech platforms will make it very clear and abundantly clear on their platform itself, with what is the kind of plan that they're offering, right? So if, let's say, it is an X fund by an X fund house, it will be appended by the words regular or direct. Now, it is quite possible that a fintech platform could also offer a direct plan, right? So, in such a case, the fintech platform is acting as an execution only platform. Now, of course, that's a second layer of regulatory complication there. So we'll pause it at that. But one important thing to understand is that there are certain fintech platforms who wish to just fulfill the service gap in terms of being an execution only platform with very limited handholding, but easing up the operational flow, and they're all right with offering direct plans. So this way, they do not receive any commissions from the AMC. You know that there is no additional distributable commission that is being charged to the expense ratio here. Look out for the word direct appended into the fund's name. On the flip side, there are a few fintech platforms which try to offer significant value added services and tries to add increasing operational layers and solve it for you. Over there, even there as well, the fund name will be appended with the word regular. So you may need to pay slightly more attention to the fund name, or if it is not in the fund name, quite often than not it will be in the fund name itself. If it is not, you may have to dig slightly deeper, probably reach out and confirm this with the fintech platform. Each one of them by mandate needs to have a help desk and a support center, and please confirm whether you are investing in a direct plan or a regular plan. Even if you compare the expense ratios, you'll get a sense of which is which. So this is the approach you must take while
Right.
identifying
Very
between the two.
important point. Exactly, very important points to be noted, just in case. A lot of time what happens is investors are not aware about these kind of differences, and they'll end up buying the wrong kind of product for themselves, and later on, when there is no guidance, especially when you buy a direct plan, that comes a problem. But apart from that, I also want to understand, Nirav, what is a basic difference in terms of return from a regular plan or regular scheme or a direct scheme? What percentage difference am I talking about in returns that we normally see?
So if we were to talk about a flat 1 year return period, right, and we compare it on a like to like basis, the difference is going to be to the extent of additional expense that is charged. Often than not, this is in the ballpark of 80 to 120 bips. That is depending on the product that there is, and there are several regulatory policies that ensure that this difference is not too large, and distributable commission is capped to quite an extent. So for a fair understanding, the additional expense charged in a regular plan would be to the tune of around, let's say, the ballpark of 80 to 90 bips on a blended basis, depending on which category. In the middle, on an average, it should be 80 to 90 bips, which is 0.8 to 0.9%. If you look at annual returns, of course, if you extend the period, a CAGR would apply. But I feel this would, help you understand what is the key differential that you can expect in terms of return on an annual basis.
Nirav, now let's also help our viewers understand, if someone is a regular scheme investor, how do they switch to a direct scheme? First, when is the right time to do this switch? Just because you are seeing a lot of people buying direct mutual funds or direct schemes of mutual fund doesn't mean that you also should be going in for that. So the criteria based on which you will be taking the decision, and what will be the process, because it seems that you will be redeeming and then reinvesting. So that will also involve a tax procedure out there.
Correct. Absolutely correct. So, one important thing that investors must understand, that, it's not quite about the timing, like it's not about what's the right time to switch from a regular to a direct plan, or, the other way around. But it's important to assess whether which kind of plan is more suitable to you, and how are you as an investor, right? For instance, direct plans are more suitable for DIY investors who understand the process of investing, who are in control of their portfolio, who understand the nuances, the operational nuances around right from KYC to onboarding to managing a portfolio on an ongoing basis, rebalancing. They are aware and able to execute all these processes and transactions. And at the same time, it could also be an investor who is availing bona fide advisory services. This could be a paid advisory service from a bona fide and registered investment advisor. So for these kinds of clients, it does make sense to switch to direct plans. However, if you're on the other side and let's say you're a client who does not really want to go through the operational hassles and who does not want to continually pay attention and is actually looking out for the value added services that some of the mutual fund distributors are indeed offering, you may want to continue sticking to regular plans. However, having said that, an important point, Kavita, as you mentioned, switching from regular plans to direct plans is as good as exiting a plan and entering a new plan, exiting a mutual fund and investing in a new mutual fund. So this entails that you will be booking a long term or short term capital gain or capital loss as applicable. And in case there are capital gains, any gains on the regular plan investment would be subject to taxes. Either it is a long term capital gain or short term capital gain, right? So there will be tax implications there, and you will be moving the residual investment to the direct plan. The second important thing to consider is exit loads. Even if you're moving to the direct plan of the same scheme, you will still be obliged to adhere to the exit load that is ingrained and is a feature of the fund. You'll still have to pay that exit load, because as I said, it is as good as redeeming out of one fund and investing in another fund. Talking about timing, if you feel that the suitability entails that you be a direct plan investor, there's no reason to wait for longer. It does make sense to switch, especially if you're a very long term investor. However, if you have a very short residual period remaining, if you do the math around the capital gains taxes and the exit loads that are applicable, it may just not seem worth it. So that's where you can stick to your regular plans.
All right, that's the note that investors might want to have with them if at all someone wants to shift from a regular to a direct plan. Thank you so much, Nirav, for being on the show and helping our viewers with this today. Thanks. All right, time for a quick break, but then post that, let's get your mutual fund portfolio queries answered. We'll be joined by Abhijit Choksi after this break.
If you like this video, then like, share and subscribe to ET Now.